While it's old news now that the Reserve Bank didn't cut interest rates in July, what was behind that? I'm going to ask Dr. Andrew Wilson that in this week's Property Insider Chat because he was one of the few economists and commentators who didn't think the Reserve Bank should drop interest rates. His discussion about the macroeconomic factors, I believe, is going to be valuable if you're interested in property and our housing markets. By the way, if you are, why not subscribe to this YouTube channel and click the little bell icon so we can keep you updated each time a new show comes out. The Reserve Bank surprised many this month by leaving interest rates on hold, and it was a decision that caught most commentators off guard. Not everyone was surprised. Dr. Andrew Wilson, chief economist of My Housing Market, was one of the few voices that predicted the Reserve Bank would sit tight. And as we've seen, he was right. So what's really going on? Why did the Reserve Bank pause when inflation and the cost of living pressures remain front of mind for many Australians? And what does this mean for property investors, home buyers, and for the broader economy? That's what I'm going to ask Andrew. Plus, we're going to dive into the latest home building trends, auction clearance rates, which didn't seem to falter despite the Reserve Bank holding rates. And we'll talk a bit about what's happening to property around the country. Hello, Andrew.
Yes, good day, Michael. And well, you win some, you lose some, don't you? I wouldn't want to be making a career on picking what the Reserve Bank does.
Every month, though, finder.com.au does a survey of over 40 economists and commentators, and you were one of, I think, only 3 who thought interest rates wouldn't fall. So I'd like to have a bit of a talk to you about why you had a contrary view.
Well, look, Michael, I felt they would cut. I thought they shouldn't, but at the back of my mind, I thought that that they would cut, and perhaps I was influenced by all the
everyone else thought it would be
the surge in opinion based on that. So. It was heartening in a way because, I've been questioning the Reserve Bank's decisions to cut, mainly because, when we look at the big picture in terms of the theory of monetary policy, it's supposed to achieve 2 aims. Firstly, it's supposed to achieve steady prices, and it has a target for that, which is between 2 and 3%. So it has a target for prices between 2 and 3%, and that's the underlying measure of the inflation rate, which takes out a lot of the volatility. So that's the first aim, and the other aim is to have full employment. So they're basically the 2 aims. And of course, how can we argue with that? Stable prices, they have a target 2 to 3%, and full employment. And my point has been really for some time we've actually achieved that. We have certainly now consistently matched that target 2 to 3% reasonably consistently, mostly this year. Yes, there are some question marks over that. Yes, it's a lot to do with the sharp fall in the price of oil, which has really got nothing to do with interest rates, and also the government's electricity handout, which it gave in last year's budget, which has created a steep decline in the price of electricity. So again, that's got nothing to do with interest rates. But nonetheless, we've achieved the target in the mid-range of 2 to 3%. And the other point, of course, is that we have a booming economy. You can't argue with how strong the economy is in terms of the labour market. We certainly, on every measure would suggest we have a full employment economy, not only low unemployment rates, 4.1% currently, and holding a little bit higher than a year ago, which was a little ridiculous because it was in the mid-3s, which we hadn't seen those sort of levels for generations.
No.
And the lowest we'd seen since the great mining boom of the noughties, the early 2000s. So we sort of achieved those 2 things. And I'm like, well, why are we cutting interest rates? It can only be for some sort of potential future event. And, the issue is with me personally, in terms of being a macroeconomist, is that, well, why do we need to keep moving towards changes in interest rates, monetary policy, which can only, and particularly when we're looking forward to what might happen, when this might just cause disruptions, then we have to go back again if things don't pan out, as we foretold, the Reserve Bank foretold. We have to then keep going back to interest rates to change them up or down. And the previous Reserve Bank board got into trouble through this because if you do remember, Michael, we had a period through the 2017s, 2018s, where the Reserve Bank kept interest rates on hold. In fact, they kept interest rates on hold for a record period of time. Now, I, at the time, was saying they should be cutting interest rates.
Yeah.
That I'm a negative about cutting interest rates. I said, cut interest rates. What are you doing? Because our economy was floundering. The rest of the world was cutting rates or had rates around zero, and nothing was happening. And I think a lot of it then was the then Reserve Bank governor's focus on the housing market, because he was, allied very closely to the sort of theory of housing market bubbles. And he was, I think part of the reasoning was, in my opinion, that they didn't want to cut rates because that might create, higher house prices, which of course it always does, and have some sort of unsustained growth in the housing market, aka a bubble. Now, of course, they had to do a 180-degree shift in their mindset then, because it became quite apparent that our economy needed more stimulus. And of course, they slashed interest rates through the back end of 2019. Again, you see, my point is that, rather than looking at the facts at the time, which was that we didn't have a full employment economy, we needed to cut rates. And now we're sort of in the opposite, where we've got that happening. And as I said, I think that whatever the mindset of the Reserve Bank is, it's not really working on the existing circumstances of the economy and the existing circumstances of prices, and it's continuing to cut. So you can't say that interest rates are restrictive at the moment, because what are they restricting? What have they restricted? The downturn in prices has been a factor in the change of the price of oil and the electricity subsidy. Now, having said all that, Michael, I do believe also that there is another reason for the pause. The Reserve Bank has consistently said that it prefers the measure of the quarterly inflation. And I think that's, if you do look at the trend, it did have a pause after February, and then we had the cut in May. Now we've had a pause in July. I think we're primed for a cut in August, which will sort of return us to the real, I guess, underlying mindset of the Reserve Bank, which is, I think it still wants to cut rates or have rates lower. It still thinks that rates are too high, sort of fundamentally, which I'm not quite sure how they justify that, but whatever. So I do think they're just waiting to say, well, let's look at the June quarter inflation rate, which will come out soon in the next few weeks, because they say they prefer the quarterly rate of inflation, even though the monthly
covers a bigger parcel of goods, doesn't it, and services.
But the point is, Michael, the monthly rate tells us the same story. And that's that when we look at the two and compare them, it's exactly the same. But yeah, if they can say, well, look, yes, it's a measure we've relied on, and we will continue to use that as our primary focus. And that's fair enough, not a problem. And but I don't think there'll be any surprises in the numbers. We know that the first 2 months of the quarter, which of course are April and May, we've already seen the results for those, the monthly results, and they are positive for lower inflation. If anything, we've seen lower oil prices since then, and there's no sign of any issues with the property market. And if we look at, in prices, and if we look at the property market, it's, in fact, it's accelerating now, the property market, Michael. So that's a sign that, consumers are still quite active out there. So I would suggest that, I'll probably change my tune in terms of my predictions for August, with saying that they will cut them. Not that I believe we need to cut interest rates. I think that's a very problematic scenario, and that we should, have a little bit more faith in the outlook for prices and the strength of the economy. But nevertheless, there are others that have different opinions based on different scenarios. And that's why economics really is an art, not a science, Michael. So that's my 2 bobs worth, for whatever it's worth.
Are they using outdated monetary policy? And do we really need to have an inflation rate between 2 and 3%? When it was high for so long, a lot of people were wondering,
Yeah. I think that maintaining those boundaries around is fair. There's a lot of rationale to the 2 to 3%. It means that it keeps prices that are still growing, and we need growth in prices because it gives us profitability in that sense, but not growing too strong, because we don't want the value of money declining quickly, right? Yeah. So I think the 2 and 3%, that makes sense to me, and we shouldn't change it because circumstances change. And maybe there'll be a bigger picture scenario going forward that would encourage that sort of a conversation. But I do think the 2 and 3% target range is rational. And of course, you can't argue with full employment. That's absolutely essential. And when we have both, which we have now, and inarguably strong economy, strong labour market, and we've certainly had a consistent 2 to 3% inflation rate. And the thing about that, Michael, is it will work, that consistency will work its way into inflationary expectations, which is important
Yes.
because we'll now be expecting, the 2 to 3%, and therefore they'll start pitching their potential price changes at around about those levels, which again reinforces that 2 to 3% a target. Now, that's not to mean we won't get an outbreak in oil. We saw signs of that with the issues with the Iran-Israel-US conflict. Oil did spike, but it came back very quickly, and it's now back to where it was before those issues. But that's not to say it won't happen again, but there's a lot more sense of stability in the oil price going forward, which is an important part of what's happening with inflation. We still have a strong economy and strong labour market, which does put upward pressure on prices because of strong competition amongst employers for available workers. And there's a big question mark about where we go with electricity, of course. Are we going to get another handout? There's no doubt that there's, underlying systemic upward pressure on electricity costs, because we're transitioning out of the carbon economy. It's only going to mean higher prices. Is the government going to continue to give us handouts? I'm not sure about that. But so there's question marks over that. But as I said, we can't keep second guessing the future in monetary policy, because then we've just got almost this, sort of whipsaw up, down, result. I think it's much more prudent to keep interest rates, even though I did say before we kept them on hold too long in 2017-18. But if we're reasonably within the targets that the Reserve Bank has set, which its mandate is full economy, stable prices, full employment, stable prices, then we should be a little bit more circumspect about changing monetary policy, because it does create the opportunity for arbitrage, people betting up, betting down, and this can have disruptions in the marketplace. And the market's always about wanting to have changes in interest rates because it wants people to bet either up or down, because that's how the market makes its money in terms of sort of commissions, Michael. So I've gone on and on about it today. I hope it's been instructive. But as I said, I think that without getting too far ahead, I'm a little bit more optimistic we'll see a cut from the Reserve Bank, because they will get that inflation data for the June quarter, and it does follow the trend of what we've seen previously with the February cut, then a pause, wait for the data from the March quarter, which came through in April, and then we had the May cut. So it's sort of following that pattern, Michael, isn't it?
Well, yes, we don't get interest rate drops every meeting. If you look back in previous history as well, usually they drop every quarter, like you're suggesting. Now, one of the other things I know at My Housing Market you look at is the building approvals. We know there's a shortage of properties. Population is booming and we're just not building enough dwellings. We know the government's got a target of around 240,000 homes a year, and building approvals are nowhere near that. And we also know that when buildings get approved, especially apartments and townhouses, they don't always come out of the ground. But there was a little bit of good news with building approvals over the month of May, Andrew.
Yes, good news, I guess, on the outside, Michael, but when we look deeper, it's still not a good news story.
No.
Approvals were up 4.2% over May. That follows two falls, a fall in March and then a 5.8% fall in April. Now, it was because, again, it was a volatile pickup in units. They were up 11, or pickup in units, which is a volatile set. As we know, units can move up and down quite sharply from month to month because you get a large development coming through one month and not followed up the next month. So units were up 11.3%. But houses have really been dragging the chain lately, Michael. After being a bright spot over the last year or so, houses have really fallen away over the last 6 months, up by just 0.5%. Victoria was the top approval state, up by 14%. Again, big developments coming through in Melbourne, elevated Victoria. But when we look at the trends, Michael, we're still the national trend for building approvals is falling. And the numbers are higher than a year ago, but the underlying trend is falling. So that's not good news. And when we look at the breakdown in units and houses, unit trends after a very strong start to the year, Michael, the trend for unit building approvals has fallen sharply over the past couple of months. And that does reflect that weak result we had in March and April for units, even though it picked up again over May. And houses, and just sort of steady-ish, but not spectacular. Maybe some early signs of a pickup in houses. And when we look at the capital city breakdown for building approvals, Michael, we can see the big surge that we've had over the year in unit building approvals. up strongly in each of the capital cities so far this year compared to the same period last year. And that's because state governments are becoming very proactive, particularly in planning approvals for higher density development. And we've seen some massive increases in all the capital cities for unit approvals. But what's a little concerning is the easing in development for houses, for building approvals for new houses. Melbourne, in fact, Michael, is down 7.7%. This year so far compared to the same period last year for house approvals. And Brisbane's flat. Brisbane, which is a booming housing market, a consistent booming housing market, is just not building more homes than it did a year ago, And as you said, the other issue is just because you get a building approval doesn't mean it becomes an actual completion, and particularly given we're still struggling with higher home building costs generally, even though there's been an improvement, they're still quite high compared to where they were a couple of years ago. So the big, we can see that the collapse in building approvals and now, the underlying undersupply of housing we have in this country has really been going on for the best part of a decade. When we peaked back in 2015, 16, our supply chain for housing, but we're down 30% since then, Michael, and that the underlying national trend for capital cities is just starting to fade away again. And as you said, we're miles behind the targets the government has set. Not that they really have much impact on home building. It's more about what happens with state governments, and we're still miles behind that. And even though we've seen a little bit of a pickup, the national capital city trend for units it's just flattened off a little bit, as we saw with the national overall numbers, and houses have started to fall now for capital city houses, which we've seen illustrated by that decline in Brisbane and Melbourne over the past year. So, it's up and down from month to month, Michael, as we expect with the building approvals, but it hasn't been as up and down as it has been because units haven't maintained their surge of earlier this year. And even if we do get, which we have had, a big change in the number of unit approvals, it takes 2 or 3 years, Michael, for units to become livable housing. And that's not going to achieve anything soon, really, in terms of what we need for our undersupply of housing. And Australia's not alone here. Most of the other similar major advanced economies have the same problems with systemic provision of housing, restraints to provision for housing for their populace.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do? We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event. So you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. I guess that means that the low vacancy rates are going to continue, rents are going to rise. Similarly, a lot of those migrants who came in 3-4 years ago have settled in and now they're into the home buying phase. Those who've entering Australia the last year or two are going to do that in a couple of years. We know they take a little while to settle in and then buy their homes. All this is going to underpin our housing markets over the next couple of years. Now, interestingly, despite the Reserve Bank's not changing interest rates, it didn't seem to bother people on the weekend when they went to auctions. There was, despite the school holidays, quite some depth to our auction markets, Andrew.
Well, that's right, Michael. I don't think interest rates are, that profound in terms of their impact in the early sense, like on a month-to-month basis or the next week following a decision. I don't think interest rate changes are that important, depending on, the cycle and other bits and pieces. I think there's plenty of momentum in our housing markets at the moment generally, and I think that it's the previous cuts that have been continuing to generate that momentum, and it does take but it takes a couple of months to build on that, and that's what we're seeing now quite clearly in our auction markets. It's the middle of winter, not the middle of the year, so we're moving onwards and upwards, but it is the time when I think all the states currently have school holidays. So it is a distracted time of the year. It is the quietest time of the year in terms of the housing market. A lot of people have headed for warmer climes, whether they be north or really north, past Australia. And that means that we do have a particularly an undersupplied, in that sense, less supply, less listings in our marketplace. But gee whiz, it hasn't stopped buyers from being active, Michael, because
No.
buyers are certainly out and about. They're not having their mid-year holidays here and not worrying about property. They're still, if anything, we're seeing, some acceleration. And of course, we've got fewer listings. So maybe that's helping push clearance rates up, because there's fewer choices for buyers out there. But nonetheless, buyers are still out there in force and are keeping clearance rates at least high, if not higher, than where they have been in most capitals. And I mean, the point to discussing the fact that we're in the middle of winter means that we're only a few weeks, can you believe it, away from the spring season.
Wow.
What a springboard, not a pun, but accidental, we have into that spring season, which typically people will now be thinking, Michael, strangely as it seems, people will be now thinking in that holiday mode about, hey, let's take advantage of this stronger market. Let's, maybe interest rate cuts coming. Maybe we should think about, getting a deal done by the end of the year, buy our new house, sell our existing house.
And a lot of people forget, Andrew, most sellers are also buyers. They actually wanting to upgrade, right size, change locations. So that's just going to mean an active spring season.
That's right. And as I said, this is what it's actually generating now. And we'll see that when listings auction numbers will start to rise in around about 3 or 4 weeks' time, Michael. And as you know, it takes some time. Well, a typical auction campaign is around about, say, 4 to 6 weeks. And that means those campaigns are being planned now. Listing numbers overall are still falling as we expect mid-winter numbers, but they will start to pick up sooner rather than later, because people are now making those decisions, those end of the year focused decisions. And that is, again, responding to the confidence that's in the market now. So if we look at the Saturday's results, or the week results to Saturday, auction numbers down in most of the capital cities. Sydney down to 546 from 545 the week before. But look at this, Michael. We can finally say we've got an 80% clearance rate. Now, when we start seeing 80% clearance rates, Michael, I think there's something going on here other than just, a little bit of a strongish market. Now, we won't get too silly here, because there is fewer listings. It isn't that time of the year, but it certainly sends a message out there that this is very much a seller's market, and that there is plenty of competition amongst buyers for available properties, even though those property numbers are lower given this time of the year. But an 80% clearance rate in Sydney is quite something, and 10% higher than where it was a year ago. So that Sydney market is certainly up and running. Melbourne also, numbers down, listing numbers down, no surprise. But another very healthy clearance rate for that Melbourne market. We almost expect the 70% plus, near mid-70 plus, mid-75%, or plus mid-70% clearance rates. Now we almost expect that, Michael, which is quite bizarre given that
week after week.
Yeah, and we just look back to what we saw a year ago, which was 67.4%, which actually was quite a positive result for that time in the Melbourne market. But we've moved on from them, and as I said, we take a little bit of a grain of salt because it is the midwinter market, and maybe that affected Melbourne, which typically, interestingly, Michael, has more of holidays tend to have more of an impact on the Melbourne market than the other capital city markets. I think Melburnians like a good holiday, and they tend to not to be that much bothered with the property markets as some of the other capitals do when it's in holiday mode.
The upper end of the Melbourne market too, Andrew.
Exactly right. And we know Melbourne has the strongest prestige portion of the market. And of course, that's the market that's very much impacted by a holiday breaks. And this is why we've seen that lower result there in Melbourne, Michael, which still a healthy result given that. Brisbane auction numbers down, back to normal with Brisbane at 40.1% in a sense. Adelaide also recorded an 80% clearance rate, Michael, which was a little bit of a shock given Adelaide's been
the old days.
Back to the old days with Adelaide, where it was a year ago. So some good signs there for Adelaide, but we have been seeing a rebound in Adelaide after a quieter period in that market at the beginning of this year, end of last year. And Canberra is certainly producing more consistently positive results there with a 65.3% clearance rate well above where it was a year ago. So a generally positive results continuing in our auction markets. And we have two 80% clearance rates, Michael. Like I said, grain of salt, it is the holiday period, but 80% is 80%. Notwithstanding that, that is a very strong result in terms of market dynamic, and one that, sellers will be relishing because it can only put upward pressure on prices, even though we aren't getting the same proportion, particularly in Melbourne, through the holiday period, of higher priced properties in the market. And when we look at the trend, it reveals what we've been stating. Sydney's certainly higher than where it was a year ago. Its full monthly trend is now nearly 79%, well, so far over July. So it's tracking at its highest clearance rates for quite some time. And certainly Melbourne is tracking at its highest clearance rates for the best part of 3 years, Michael. So, some very solid results, very positive results for a reviving Melbourne market. And there's no question about that now. That Melbourne market is now certainly gravitating towards being very much in favour of sellers. Brisbane still tracking around about 50%. Has been a better month or two for the Brisbane market in terms of auction clearance rates, but we know that Brisbane market remains strong, notwithstanding what we see with clearance rates. Adelaide picked up, as we saw on the weekend, with an 80% clearance rate, starting to look like the Adelaide of a year ago, which was Australia's strongest market. And Canberra, I think we're just about ready to say the Canberra market is reviving, because we're now certainly seeing an upward trend in clearance rates over the past 3 months. And given how strong that Sydney market is, that's no surprise, Michael, that Canberra is finally dragging itself upwards and onwards. And even though I'll say the same thing, we need to watch a couple more weekends to see that that's consistent. But certainly the recent results are very positive for Canberra. Finally, if you're looking for those auction clearance rates, the snapshots released on my LinkedIn site, Doc Andrew Wilson at LinkedIn, every Saturday night at 6 o'clock. And of course, Michael releases the full national report, which includes the regional breakdowns for Sydney and Melbourne and the top 10 sales under the hammer over the week for all the capital cities on his social network. So I look forward to that one. So another busy week, Michael, and we've had well, it's always a busy week, isn't it? We've had a big discussion on monetary policy today.
Macro view is important to take, because the news is always about the latest headlines or the next hotspot or what's going to happen this week. And it is good every now and then just to step back and see what's behind it all, the clues behind the news. So thanks again for giving us those insights, Andrew. I look forward to catching up with you next week.
Thanks, Michael.